What's going on, guys? Welcome back to the channel and welcome back to my 529 college savings plan while we're tracking my kids' journey for saving for their 529 plan. Today, I want to talk about and show you a strategy that I'm going to use with my kids or just setting it up with my kids to basically fund the 529 college savings plan tax-free and then use it for educational purposes, also tax-free. So tax-free going in, tax-free going out. So let me explain it. Let me walk you through it. And if it works for you, maybe you can do it yourself. So here's what I'm currently doing. So I have my 529 college savings plan that you've probably seen some of my other videos on, and I'm going ahead and funding it. So me is over here, and I'm basically just putting the money directly into the 529 plan. And that is after tax, just like a Roth IRA contribution. So it's after tax dollars, comes from my paycheck, from my earnings, goes to the checking account, goes in the 529 plan. Now, here's what I'm changing up. Now, there's a tax loophole, and that loophole says that if you are a sole proprietor partnership and you own that partnership 100% between you and your spouse, your Schedule C filer, LLC, 100% ownership, you can hire your kids. And there's a big benefit here. So with that, if you're making under the standard deduction for your kids, then that's tax-free on the federal income tax side. But there's another added benefit here. So I'm going to go ahead and say, okay, this is me, and we're going to go ahead and we're going to have our kids down here. But instead of me, the business is going to pay for it. So I'm going to X myself out there, and I'm going to put my LLC up here. Now, I own a short-term rental business. I own a few different businesses, but this is the one that we're going to use for this walkthrough. So this LLC right here, 100% owned by myself. And this right here goes to pay our kids, where we can now avoid any federal income taxes up to the standard deduction, basically how that works. But in addition to that, we do not have to pay any of the FICA taxes because they're employees, but because they're your kids and I'm 100% owner, or they're my kids, 100% owner, then there are no FICA taxes. That's the 15.3%. So it's 7.65% for the employee, 7.65% for the employer. Add that up, 15.3%. So we get to avoid all that. We get to avoid all of the taxes as long as we're staying under that standard deduction. Now, I'm going to go ahead and say that they're going to be paid by my LLC, and then they can go ahead and fund it. Now, when you pay them, it has to go into their UTMA account. And don't get sloppy here and say, you know what, okay, fine, it'll actually pay them, but I'm just going to go ahead and fund it. No, you want to go through all of the steps and set it up correctly. And what I mean by that is get an employment contract. Yes, have them sign it. Go ahead and keep that copy. Make sure that the LLC is actually paying them. Put that into their UTMA account. And if you don't know what the UTMA account is, it's basically just their own checking or savings account. But because they're a minor, it has to be a UTMA account. It's basically how it works. Goes into the UTMA account and then into their 529 college savings plan. So as long as you're staying under the standard deduction, and I'll go ahead and bring that up on the screen here. Standard deduction for married filing jointly is $27,700, and we got right there for single, because it's going to be your kids. They're not going to be married. $13,850 for 2023. So let's run through an example to see how much we can actually save, and we're going to use that number. You can pay them obviously less than that, but up to that amount, because it's the standard deduction, they're not going to pay any federal income tax. So we'll say $13,850. So if we do this $13,850, that means we're not going to pay any self-employment. But let's do the federal income tax example first. And what you want to look at is not their tax bracket, but yours. So let's assume that we're in the 24% tax bracket. So we can literally multiply this by 24%. And let me drink out my calculator. So 13,850 times 0.24. That's going to be $3,324. This is the amount that you're saving by doing this. So you're not going to pay any federal income tax. Now, we can also do the math for the 15.3%, but you're not really saving that because otherwise you wouldn't have hired your kids, have them do some work for you. So, but we can still work out that math. 13,850 times 0.153 is $2,119.05. So $2,119. There we go. And there's going to be another benefit here I'm going to show you as well. So we can avoid all of these taxes right here, and we can go ahead and add those up. So we got 2,119 plus 3,324, and that's $5,443 in taxes that we're not paying. So you're not going to have to pay any of those taxes. So that is a great way you can do it. You just want to make sure it's legitimate. I do have a video on how to hire and pay your kids, so you can see some of the other nuances that you want to set up, as I've already mentioned. But it has to be bona fide work. So you can't do it for your newborn. So I'm going to do it with my 8-year-olds, my twin 8-year-olds, and they're going to work for. Actually, I'm going to have them set up for actually 2 separate companies. Have them do a little work for one, a little work for the other. But that's neither here nor there. You just have to have your sole proprietor, LLC, partnership owned 100% by you. You hire the kids, and it goes into their UTMA account and right into the 529 college savings plan, basically pre-tax. And then when it comes out as a qualified expense, it is also going to be tax-free. Huge benefit. In addition to that, funding your kids' college, you don't have to just use the 529 college savings plan. This strategy also works if you're doing a Coverdell. Now, I've talked about the Coverdell before. You can use the Coverdell. It doesn't need to be earned income for the Coverdell. You can just go ahead and gift them the money. So if they're not, you don't want to get this too high because it has to be legitimate. And if they're not doing that much work and you're paying them way over market rates, then that's not legitimate. So you could also just gift them and give them the Coverdell if you're over the Coverdell thresholds for income limits. In addition to this, you can also do the Roth because the Roth needs earned income. So these are all great strategies to set it up a little bit differently. And then this becomes a write-off to the business because why? Because you're hiring your kids. So that's reducing your taxes because it's an expense to the business. So that is a huge benefit. That's something that I'm actually changing right now, and it will help me reduce my taxes a little bit further while still funding their college savings plan. So hopefully this has helped. If it has, let me know in the comments down below. And if you've enjoyed this video, be sure to subscribe, and we'll see you on the next one.